Hello, everybody, and thank you for tuning in for today's webinar. I think it's going to be timely, and I know it's going to be very informative and a good one. I can't thank you enough for taking time out of your day, for joining us. I know it's important for us to provide this kind of information for you, and it's truly something that my team really, basically in a nutshell, they love putting it together. So I think you're going to find today's presentation really, really good. So once again, thank you for tuning in, and I'm hoping you will get as much out of this as we have put into it. So today, as you know, I have 16 very talented team members that I'm surrounded by. Today, I have two of my rock stars. I have Marty Shields, our Chief Wealth Advisor, and Paolo LaPietra, our Wealth Advisor and Portfolio Strategist, and they will be helping me with the presentation. And as I said, I think you're going to get a lot out of it. So today we're going to discuss basically a market overview, our portfolio positioning, COVID and Ukraine. I thought I've seen it all in all the years that I've been helping manage money for clients. I go back to Black Monday of 1987. Yes, I was managing money back then. And I think of the credit crisis of the late 90s, the dot-com bubble of the turn of the century, unfortunately 9/11, the Great Recession, and now I add COVID and Ukraine onto my resume. So we've seen a lot, and not all wealth managers really understand volatility, but we do. And I think after today's presentation, you'll see that we don't have any knee-jerk reactions. We don't panic because of any events that are going around in and around the country and world. We're going to talk about inflation and the Federal Reserve, and what's really our thoughts of the bull market case, and is there a case for a bear market? As we know, what is inflation? Inflation is basically spending more for goods and services, and we know at the gas pump we're spending a whole lot more. Maybe those tax credits that were given for people that bought electric cars are starting to pay off, and this is just a great cartoon that my team put together. You know, the car is electric, I just want directions, and when you look at the price of gas, that's one of the big reasons that we're seeing inflation, which we'll get into later in the presentation. This is a good slide. Basically, you know, if you look last year, 2021, because I like to keep things in perspective, and this is really mostly a blend of different indexes. So the large cap equity index, domestic, year to date, we're off of just shy of 5%. Last year, we were up almost 29%. Small caps this year down a little bit more, 7.5%. Last year, we were up about 15%. International developed equity this year down about 6%. Last year up about 12%. And emerging markets this year down about 7%. And last year was down 2.2%. The bond index down 6%. Last year down 1.5%. The commodity, anybody who, commodities because of inflation have done well this year, up almost 26%. And last year it had a good year as well. And let me just add a little flavor to this, because I like to put it in perspective. I've been talking about it on radio often. So the S&P 500 index, as we sit here today, is down 6% year to date. And last year was up almost 29%. The NASDAQ, which is one of our core positions, is down about 13% year to date. And last year was just really on fire. It was just a great investment to have. Actually, NASDAQ has been in my clients' portfolios for almost 20 years now, and that's one of the reasons why our returns are stellar. And if you look over the last 15 years, since the beginning of the Great Recession, which started in October of 2007, and I just want to put it in perspective. So you think October 2007 to March 2009, the S&P 500 index lost almost 50%. And I remember that people thought the world was going to end, fall apart, and so forth. Since then, obviously, 2 years ago, we had COVID, down 34% in a few short weeks. And now, because of mostly inflation and the Russia invasion of Ukraine were off about 6%. Your average return in the S&P 500 index over the last 15 years, including those very volatile times, is 10%. Your average return in NASDAQ for the same 15 years is 15%. That's a big difference. One of the reasons why we have as much NASDAQ in the portfolio as we do the broad stock market index. But bonds, as we've been saying, have come off a 40-year bull market, and the average return in the bond index over the last 15 years is about 3.5%. So people that are in bonds for safety, as I sit here right now speaking to you, the bond index is off 10% year to date compared to the S&P off 6%. And this is one reason why we're very underweight bonds. And in our tax managed portfolios, we don't have any bonds. In hindsight, it was a brilliant move, and I'm very happy that we made that move. We also still don't have any developed equity in the portfolios, nor do we have any emerging markets in the portfolio. I'm not sure when we will ever add those back into the portfolio. Our US stock market returns have been just stellar, and at the moment, we don't have any intention of adding it. But my caveat is that doesn't mean that we might not later on. No matter how great the values are, we have been really getting some pretty spectacular returns right here in the good old USA. So, as I said, we're overweight US equities, even with the volatility, because we believe that the stock market, once we get some good news, there's a lot of bad news built into the stock market right now, which we'll go into deeper in the presentation. We continue to like technology, and NASDAQ is off more than the broad stock market index because it has about 65% weighting in technology, but we believe in technology, and we believe that NASDAQ will come back. We're overweight energy, which has been good for us this year, and financials. We're very underweight, as I just got done saying. International equities, we have no weighting in it. Bonds, we're very underweight, and we have really no high yield debt. So with that, I'd like to ask my colleague, Paolo LaPietra, who's a certified financial planner and one of my wealth advisors, but Paolo really spends a lot of time in the portfolios, folks. And I think, Paolo, I think this is your section, so let me hand it off to Paolo.
Yeah, no, thank you, Steve. I appreciate that. So I'll be spending the next few slides talking about how we're currently positioned in our portfolios. So for the past 5 years, we've been underweight international and have actually completely taken it out, developed and emerging markets out of the portfolio as of the last 2 years, as Steve mentioned. This has been a strong driver for outperformance for us, which is shown here. If we look at the slide showing the S&P 500 up 6.17% over the last year compared to MSCI EFA, which is down 10.26%, and MSCI emerging markets down almost 18%. We're going to continue to be overweight US going forward due to our energy independence, strong consumer, corporate earnings, tight labor market, strong housing market, you name it. But we're going to continue to watch international holdings for a potential favorable entry point at some point in the future. Our alternative sleeve has also been a highlight for outperformance. We initially added this asset class to our portfolio as an alternative to bonds due to the headwinds we saw coming for the bond market, most notably rising interest rates and inflation. But our alternative positions have also been a great hedge against equities as well. If we look at this graph here, we could see our market neutral income fund highlighted in blue, up 1.56%. This fund gives us exposure to all of the highest dividend paying companies in S&P 500, but uses futures contract to eliminate any market volatility. The next position is our US equity buffer position, highlighted in purple, down only 0.76%. This position gives us direct exposure to the S&P 500, but caps the amount we could have on the upside and buffers the amount we could lose on the downside. As you can see, both positions significantly outperform the S&P 500 year to date, which is highlighted in green, being down about 5.5%, and the US aggregate bond index highlighted in orange, down about 8.7%, depending on which day you look at. We're going to continue to add positions like this into the portfolio as a way to kind of add total return for our clients, but on a very risk-controlled basis. So next few slides, I'll be discussing COVID and Ukraine. 2 years into COVID, but I think I kind of speak for all of us when I say it feels much, much longer than that. Through global shutdowns, social distancing, mass mandates, we all did our part in trying to get ahead of the curve. And when we look at the chart here, we could see daily reported cases along with the 7-day moving average trending in the right direction. I always hesitate to ever say we're out of the woods because I feel that this virus will be around for a long time, most likely mutating, weaker like the flu. But with effective vaccine rollout, which seems to create some herd immunity, we could begin to return to normalcy. In fact, as of yesterday, with the court ruling in Florida, the guidance as of now is masks are optional in public transit. And J&J has recently suspended their COVID vaccine forecast due to surplus supply. These are all great signs. And this is important because there's still so much manufacturing, production, and supply chain issues that continue to be affected by COVID. So if we can continue to trend towards normalcy, we'll see relief in a lot of business logistical issues. So as we all know, inflation came knocking on our doorstep early last year, but Russia-Ukraine crisis only helped push inflation into a higher gear. Agricultural products from wheat to barley and metals from copper to nickel, these factors have disrupted global supply chains and will continue to struggle as the conflict continues. Oil prices have stolen the headlines as we all felt at the gas pump with the world's reliance on Russian oil, especially for Europe and most notably Germany. But if we look at this graph here, we could see inflation expectations steadily rising after the Russian invasion, but they've begun to taper and even level off starting at the end of March. This shows that supply chains over time will figure out how to become more efficient given the resources available to them. But that being said, if there is any diplomatic resolution between Russia and Ukraine in the short term, this will drastically help resolve a lot of global supply chain issues and provide organic relief to inflation. One major concern from the Russia-Ukraine crisis was global muted growth for corporate earnings. Here we could see earnings per share growth expectations for 2022 are still very strong, and this has to do with corporate fundamentals and a strong consumer. Corporations have historically strong balance sheets, and we've seen a record number of share buybacks from companies and increased dividend payouts. And when you couple that with a strong consumer that has been in one of the best spots in the couple of past decades, we're going to see strong earnings growth. Again, piggybacking off of the last slide, if we see any diplomatic resolution soon, we should see these expectations only strengthen. So the next few slides, I'll be discussing inflation further and how the Fed is taking action. So inflation is the highest it's been in 40 years. The headline pretty much says it all, and the consumer has absolutely felt it. Looking at this graph here, the consumer price index, which is a measurement of goods and services purchased by household, has reached 8.5%. This has been a dramatic shock for the consumer who's faced little to no inflation going back all the way to 1990, which is circled as the Great Moderation. If we look at the chart in the bottom right, we could see how year over year inflation affects real GDP, which is an economic growth measurement, and S&P 500 returns. If we look at the column that shows year over year CPI change between 4 to 9%, which we're currently in, we can see real GDP growth averaging about 2.6%, which is roughly in line with what Fed expectations are, but S&P 500 returns averaging less than 2%. So in order to maintain healthy market returns over the coming years, it's imperative that inflation fall towards historical norms of about 2 and 4%. So let's see what the main drivers of inflation are. Where inflation is and where it isn't. Well, if we look at overall inflation, which is highlighted in yellow, being at 8.5%, inflation is absolutely here and there's no question about it. But if we look at the top of the list, we could see gasoline, used vehicles, hotel rooms, airfare, and rental cars being the top 5 main drivers, with gasoline taking the cake at 48% year over year change. Going back a few slides to the Russia-Ukraine crisis, we know that this conflict has led to constraint on global oil supplies, sending gasoline prices skyrocketing. One could argue, though, that gasoline prices won't be sticky and most likely come down as countries find new suppliers of oil or if Russia Ukraine find diplomatic resolution. Used cars take second place with 35%, and this is simply due to the chip shortage for new cars, which push consumers looking for a car to go used. And when chip manufacturers iron out those ripple effects caused from COVID, this should solve the new car shortage and stabilize the new and used car markets. Hotel, airfare, and rental cars are seeing a surge in pricing as demand for these services were almost non existent during 2020 and 2021 due to COVID. The point I'm trying to make here is it's important to discern what goods and services are elevated due to short-term environment we're in and what goods and services will remain elevated for the long term unless the Fed steps in. One of the main questions being asked about inflation, as rampant as it is if the Federal Reserve is behind the curve when it comes to raising interest rates. For those of you listening that are wondering what the Fed raising rates has to do with inflation, the application is quite simple. When the Fed raises the federal funds rate, this makes borrowing for corporations and consumers more expensive. When borrowing is more expensive, people are less inclined to borrow money. And if they're less inclined to borrow money, they're going to be less inclined to spend money, dragging down the overall demand for goods and services, thus bringing down the prices. So if we look at the chart here, we could see inflation, labor market conditions, and the federal funds rate. When Fed Chair Jay Powell cut interest rates back in 2020 to stimulate the economy during COVID, he said the Fed would begin raising rates when inflation got back to the Fed target of 2 to 3% and labor conditions come back to pre-pandemic levels. Well, as we could see, inflation is much higher than the Fed target and labor conditions are at the strongest since the last 20 years. Yet the Fed has only raised the federal funds rates only 25 basis points. Many economists, including St. Louis Fed Chair Jim Bullard, have called for multiple 50 basis point rate hikes this year to get back to the 2% federal target. But the Fed has to be careful to not hike rates too quickly, which could lead the economy into a recession. It's important for Jay Powell and the rest of the Fed board to understand what prices are elevated due to supply chain issues and political issues, and what prices are elevated due to excess demand. Because if prices can organically come back down through resolved supply chain and political issues, then the Fed can ease back up to that 2% federal funds rate over the next few years, which will be very, very good for markets and the economy in the long term. Next, I'll be passing off to my colleague, Marty Shields.
Thank you, Paulo. So as Steve mentioned, our outlook for both the economy and the markets, it tends to be positive from where we start now. And I'll go through what we are looking at from an economic data and market perspective to support that view. I would highlight, though, that even though we think that we'll trend higher here from a market perspective, some of the risks have increased, which I'll highlight in the potential case for a bear market. The other thing to remember is that we've seen returns of 10 to 14% the last few years, averaging, and even over the last 10 years. The likelihood of more muted returns in the equity market for the next 1 to 3 years are much more increased from where they were. So just setting investor expectations as we move forward over the next couple of years or 2 or 3 years is important. So one of the strongest areas that we've seen, it's an important part of the economy, is the housing market. And from our perspective, with mortgage rates hitting 5%, you're probably going to see prices in many markets not increasing as quickly, or maybe even plateauing, or in some cases even declining. But this is not a bad thing. In general, the housing market is very strong. It's not a bubble situation like we saw in 07, 08. And really, it's not an issue with lending. It's an issue of supply with housing. What you see here is the population growth with that greenish blue line going from under 240 million in 1980 to up to 340 million in 2021. And you can see, so tremendous population growth, but the actual number of existing home sales has declined over the last 10 years. So really quite amazing that we've had that much increase in population, but actual existing home sales has declined. And that is really a function of the amount of new homes being built. So what this shows you is that over each decade back to 1930, how many homes in the millions have been built. And in the last decade, the 2010s, only 5.8 million homes were built. And you have to go back to 1930 to see that same level. So really, it's a situation where we have not been building enough homes. There's multiple reasons for that. But that is really what's driving the really robust, strong housing market versus excess lending by banks or speculative buying by potential buyers. The other area that's just so strong is the labor markets. This graph looks at the openings that exist, and you can see they've been trending higher over the last 10 plus years. And what we're expecting as the Federal Reserve starts to raise interest rates, you actually see the number of openings start to decline. And it's one of those things where that's not a bad thing, right? So this is going to kind of bring the labor markets more into equilibrium, and it's going to be really a positive. But the likelihood of mass layoffs, kind of this recession type of situation, as we see it right now, given the overall strong job market, is unlikely. The other real positive that we see out there to keep this economy, markets moving higher, is the personal savings rate. So you can see with this graph, we're at a level that we have not seen since the 1940s. And if you look at it, from 1973, we were at around 14% savings rate, down to just over 2% in 2008. And it's been increasing then, in particular with the pandemic. And so as we see this, the consumer makes up 70% of the overall economy. They're really in a position to spend. And that's not spending using debit cards and credit cards. It's spending using cash they have in their bank accounts, which is a real strong thing and can continue to push the economy higher, and their spending going strong for a number of years. From an inflation perspective, it's good to look at where we are now versus other periods of high inflation. So if you look at the maroon line, in the 1970s and 80s, we were in a situation where inflation was high and moving higher because people's expectation for inflation was that it was going to keep elevating. So what that did is, you think about it, if you thought prices were going to be higher a year or two from now, whether it's buying a car or putting on an addition, you want to do it now because your expectation is that in a few years it's going to be more expensive. Whereas now we're on the blue line, it's just the opposite. And we hear this with talk with clients. Many people's expectations with inflation is that in a year or two, after some of this spike in demand has evaporated and also supply chains have worked their way out, the likelihood of prices being lower is greater. So, you see a lot of projects that people want to do, but they're putting on hold until a year, 2 or 3 from now. And so, again, this should be a situation where this allows inflation to decline, that at some point here we'll hit peak inflation and kind of get to a more moderate level. It will also allow demand for goods and services to continue for multiple years as people wait for those prices to come down. And this kind of shows what those expectations are for inflation. The blue line is inflation expectations for 1 year out, and the yellow line is for 5 to 10 years out. And you can see that certainly in the short term, people's expectations for inflation is pretty high. We haven't seen a level this high since 2010 or 11. But when you look at the 5 to 10 year inflation expectations, it's really in line with where we've been for the last 10 to 14 years. And expectations of where inflation is going to go is a big driver of where inflation actually goes. So to us, as we looked at this is a real promising sign that inflation, it's not transitory like the Federal Reserve was saying 2 years ago, but the likelihood of it staying at a very high elevator level is not that great either. So I think one of the big important things that we've talked about over the last year is the acronym TINA. And that is, there is no alternative as far as investing. And certainly that has been the case when you look at bonds. As Steve mentioned, they've had negative performance and really underperforming a lot of other asset classes. And really right now, whether you have your money in cash or bonds or other investments, the actual yield you're getting, even if it's positive in nominal terms, but when you apply inflation to that, it's actually negative. So we've talked about this. If you have cash in your bank account, you may feel good when there's volatility, but your purchasing power is now declining at a very high level, anywhere from 4 to 8%. So your actual real return on that is negative. And this is a reason why, again, investors will probably be more inclined to want to be in equities where they can get dividend yield and potential growth versus negative yield. It's also why I think the US market, when you look at the alternatives as far as equity markets, will also be an area that people are going to want to invest money in. When we look at consumer sentiment, we're at very historic low levels, and these are levels that you usually see during or after a recession. So, right before a recession, consumer sentiment is always very high. So, from a contrarian perspective, we view this as a real positive, that this could propel consumers to spend more. And then also, as we look at the next slide with investor sentiment. Investors right now are very bearish, very bearish. And we haven't seen this since 1992. And if you remember, starting in 1992 up to 2000, there was an 8-year bull market. Now, again, we don't necessarily think we may be in a coming of an 8-year bull market. We see the types of returns in the 1990s. But we do think that right now, with investors being so bearish, from a contrarian perspective, that's a good thing. That means a lot of people are not in the markets. They're sitting on cash. And if, as Paolo mentioned, if you're able to get some resolution over in Ukraine, if the Federal Reserve is able to dampen some inflation, it could be a real positive for the markets and investors. And we've talked about the yield curve, right? So as the situations where the yield curve inverts, and what that means is the interest rate that you can get or that you pay for a 10-year U.S. Treasury is below either the 2-year U.S. Treasury or, in this case, the 3-month U.S. Treasury, that can be indicative of a coming recession. And you can see, in this case, this is looking at the 3-month versus a 10-year, which is the measure that we really like to look at. It's almost a given that when you have that happen, that inversion happen, that very quickly, within 6 months to a year, a recession period occurs. Well, what you're seeing right now in the yellow circle is we're just the opposite. That actually, the yield curve is actually steepening. It's not inverting. So this is a real positive for the economy and the markets, and would not indicate that we're getting close to a recessionary period. But as we look at this, the data out there, certainly the likelihood of a recession or bear market has increased, given some of the issues in Ukraine and some of the other economic data. So we want to highlight that so you understand what we're looking at. And we have made a few portfolio adjustments, including adding a JP Morgan covered call fund that is a little bit more conservative. It still has equity allocation, but has a yield between 6 and 7%. So we have made some adjustments to the portfolio. But again, from our overall outlook, the greater odds, much greater odds, is for markets to trend higher from here and the economy remain stronger. But let's look at what we're looking at from a recession and market perspective. First of all, as labor markets and the unemployment rate gets very low, this tends to precede a recessionary period. But what I think is worth looking over this long period of almost 70 years is you can go multiple years, in some cases 5+ years, with the unemployment rate at a very low steady state level, right? So, this can be problematic in indicating a recession, but it can go many years, as you see in multiple decades, at that low level, and that's probably what our expectation is as we move forward for the next few years. Earnings per share has increased dramatically as companies have increased their prices and increase their earnings through increased revenue. And that's really one of the real benefits for inflation is these corporations that have raised their prices. You can see with the blue forecast that the estimate is that companies will continue to be able to do this. But this is a risk, right? So the counter to that is they can't raise prices high enough to offset increased cost, and that lowers earnings per share. So as we look at some of the risk out there, this is certainly one of them that we're watching and seeing exactly what happens as corporations report earnings. The other, as we talk about, is the price to earnings ratio. What are you paying for $1 of earning? It's been elevated. In 2020, it hit a high. It's come down from there over the last couple of years, which is a good thing, but it's still above average. So, this is a risk to the market as we go forward as far as valuations for earnings, but nothing that we think, overly concerning, but something that we're looking at. And then finally, as the Federal Reserve starts to increase interest rates, we've looked at historically what happens. The darker blue line shows you that if it's slow tightening, the market tends to move higher after the Fed starts to initially raise rates. The orange and yellow line indicates all types of rate increases. And in general, again, as the Fed starts to tighten, the market tends to move higher. Now, with the lighter blue line, that is if the Fed raises them very quickly. And what you see is it's a little bit more choppy, right? So this is probably an area that we may be in. And as I've mentioned, even though we're bullish as far as where the market's going to go from here, we'll probably see a lot of volatility in the market. And this would show that. But I would highlight that even in this case, you're really seeing a market decline of about 5%. So this would even support what we're talking about, which is continued volatility in the market, but overall positive returns over the next year, year and a half. I'll just leave you with some closing thoughts, and then if Steve, you want to chime in. I think the big thing, as always, is understanding what it means to be a good investor in times of volatility, having that long-term outlook. And then if you have any questions, absolutely, we really encourage you to call in, whether it's we're starting to meet with people in person or a Zoom call or a phone call. That's what we're here for. We want to talk to you about what's going on in your own personal situation, whether your allocation should change, and also making sure that from a financial planning perspective, everything is in a good spot. And that's really where the rubber hits the road is, we can talk about returns in your portfolio allocation, but where do you stand from a plan perspective? And we really encourage you to, set up a meeting and let's have that discussion. Steve, do you have anything that you want to share before we close out?
Absolutely, Marty. So, Marty, Paulo, thank you very much. The presentation I thought was really great. Hopefully, our clients feel that it was informative. Folks, as Marty and Paulo, they've given you some really good information. All the years that I've been managing money, the one thing that I know for sure, no matter what the event was, no matter what caused the market correction, bear market recession, because there will be and hopefully everybody read the disclosure, we can take that down. There will be another correction. There will be another bear market. There will be another recession. We just don't know when. We're hopeful that we won't go into a recession. One of the reasons why the Fed is being very aggressive right now is, I think personally, they were late to the party. As I started out the presentation saying that, when they called inflation temporary and transitory last year, they really probably should have started tackling this high inflation sooner than they did. So now they need to be a little bit more aggressive. But a year ago, they said they weren't going to raise interest rates until 2023. Now they say they raised it for the first time 3 weeks ago, and they say 6 more times this year. More than likely in May, we may see a 0.5 percentage point hike, and then maybe again in June, but it's a moving target. And that's why until we're through the year, we'll look back and see just how many times they raised interest rates and how much. Because if inflation gets under control, they won't need to be as aggressive. And we're hopeful that they will be able to manage this. As I say on the radio often, the Fed needs to tap their foot on the brakes, slow down this economy from growing ever so fast. And if they do that in a good way, the car will come to a nice stop. And you know how you get that little, you kind of, the car comes to a stop and rests back. Well, hopefully they'll be able to do that with the economy. So we don't think the world is coming to an end. It's not falling apart. We think there's a lot of bad news built into this market right now, because what the market doesn't like is surprise. And we know that interest rates are going up. We know that Russia invaded Ukraine. We know that corporate earnings are being reported right now. And so far, they're actually pretty good. Inflation hasn't hurt a lot of earnings. And that's why we're hopeful that at the end of the year, the markets will be higher. As Marty said, if I can echo him, if you have any questions whatsoever, if you'd like to see anything different in the webinars, we plan on holding a webinar once a month. Please reach out to us. In the meantime, stay well, stay healthy. Thank you for taking time out today.